September 2025, Shanghai. Behind closed doors at the Shanghai Gold Exchange, representatives from the People's Bank of China are making a pitch that could reshape the global financial system. The target's central bankers from friendly nations, particularly in Southeast Asia. The offer: store your gold here in China, away from Western vaults, away from London, away from potential sanctions and seizures. At least one nation accepts the meeting is confidential. No press releases, no official announcements. But when Bloomberg breaks the story weeks later, gold prices surge to fresh records, touching $3,790 per ounce. That was just the beginning. By January 28, 2026, gold would hit $5,589, the highest price ever recorded in human history. This isn't just a bull market. This is the end of an era, the end of Western dominance over the world's most trusted asset. And it started with meetings that the public was never meant to know about. This is the story of how China positioned itself to challenge London's centuries-old supremacy in gold custody, how central banks from Turkey to Poland to India bought over 1,000 tons of gold for 3 consecutive years, how the dollar's share of global reserves fell from 72% to 58%, while gold reserves reached $4 trillion, matching and potentially exceeding foreign holdings of U.S. Treasury securities for the first time in modern history. And this is the story of what happened in January 2026, when everything accelerated beyond anyone's projections, when the U.S. president launched a criminal investigation into the Federal Reserve chairman, when geopolitical tensions exploded, and when gold didn't just break records but shattered them, gaining over $300 in a single day. Let's start with what happened in those September meetings, because understanding this moment requires understanding what China was really offering and why it terrified Western financial institutions. For over a century, London has been the undisputed center of the global gold market. The Bank of England's vaults hold more than 5,000 tons of gold reserves from countries around the world. The London Bullion Market Association oversees 90% of global over-the-counter gold trading. It's the deepest, most liquid, most trusted marketplace for gold on earth. That trust was built over generations, centuries of property rights, established legal frameworks, the network effects of having the largest concentration of gold in the most sophisticated market infrastructure. But trust, like gold itself, can be melted down and recast into something new. And in 2022, something happened that sent shockwaves through every central bank treasury room on the planet. The Western allies froze $300 billion of Russian central bank reserves. $300 billion, not Russian oligarchs' yachts, not private wealth hidden in offshore accounts. Official central bank reserves, the money Russia's central bank held as insurance against economic catastrophe, gone, frozen, unusable. The technical justification was Russia's invasion of Ukraine. The practical message to every other central bank watching was unmistakable. If you hold your reserves in dollars or in Western financial centers, those reserves only exist as long as the West allows them to exist. Your sovereignty is conditional. Your insurance policy has a political exclusion clause. Central banks around the world took note, not just adversaries of the West, everyone, because geopolitics shifts, alliances change. Today's friend can be tomorrow's target. And if the West could freeze Russia's reserves despite decades of integration into the global financial system, who else might be vulnerable? This wasn't theoretical anxiety. In 2024, Moody's downgraded the U.S. credit rating, eliminating the country's final unvarnished AAA credit score. U.S. government debt was surging past $35 trillion with no credible plan to reduce it. Deficits were running over $2 trillion annually. The political system seemed incapable of fiscal discipline. The dollar was still dominant, still the world's reserve currency, but the foundation was showing cracks. Into this environment of growing unease, China made its move, not publicly, not with grand announcements or diplomatic fanfare, quietly, through the Shanghai Gold Exchange, which falls under the People's Bank of China and was set up in 2014 as the main venue for foreigners to trade gold with Chinese counterparts. The pitch was elegant in its simplicity. Store your gold in Shanghai, trade on the Shanghai Gold Exchange, custody it in warehouses linked to the exchange's international board, reduce your dependence on dollar-denominated assets, reduce your exposure to Western financial systems where your reserves could be frozen on political grounds, build financial sovereignty. The strategic implications were enormous for China. Attracting foreign central bank gold reserves would enhance Beijing's role in the global financial system. It would support China's goal of reducing global dependence on the dollar. It would help internationalize the yuan. It would create deeper financial ties with partner nations. It would make Shanghai a rival to London as a global gold hub. For the central banks being courted, the calculus was more complex. London's advantages were formidable: deeper liquidity, established trust, legal protections built over centuries, the sheer network effects of having most of the world's gold in one place. But China offered something London couldn't: a sanctuary from Western sanctions. Physical gold stored in Shanghai couldn't be frozen by Washington or Brussels or London. It represented true sovereignty, not conditional access to Western financial infrastructure. And for emerging market central banks, particularly those in Asia, Africa, and Latin America, that sovereignty was increasingly valuable. According to people familiar with the matter, at least one Southeast Asian country expressed interest. The details remain confidential. Who exactly? What volume of gold? What timeline? These questions remain unanswered. But the fact that any nation engaged seriously with China's proposal signaled a crack in London's monopoly that could widen into a chasm. When Bloomberg reported the story on September 23rd, gold prices responded immediately. Spot gold rose as much as 1.2% to a fresh record after the news broke. It wasn't just the announcement itself, it was what the announcement represented. As Wael Makarim, financial market strategist at Exness, noted, markets may be speculating that China's bid to host foreign gold reserves signals a long-term push to elevate its role in the global monetary system. Investors could be interpreting this as incremental de-dollarization momentum, which could support gold. But here's what made China's September initiative truly dangerous to the existing order. It wasn't happening in isolation. It was happening in the context of the most extraordinary central bank gold buying spree in modern history. In 2022, central banks purchased 1,037 tons of gold, the highest level since 1967. In 2023, they did it again, over 1,000 tons. In 2024, 1,045 tons, 3 consecutive years above 1,000 tons. For context, in the entire decade of the 2010s, central banks averaged around 400 to 500 tons annually. This wasn't buying, this was accumulation, systematic, strategic, and it was accelerating. The World Gold Council's 2025 Central Bank Gold Reserve Survey, conducted between February and May, revealed something startling. 95% of participating central banks expected global gold reserves to increase over the next 12 months. 95%. That's not a trend. That's a consensus. Even more striking, 43% of central banks plan to increase their own holdings, a record. The trend was particularly pronounced in emerging market and developing economies, where 48% planned increases compared to just 21% in advanced economies. The message was clear. The emerging world was shifting away from dollar dependence and into gold at an accelerating pace. Who were the biggest buyers? China consistently increased its reserves month after month. By May 2025, China held 2,296 tons. In September alone, Goldman Sachs estimated China added 15 tons, though China's official report showed only 1.24 tons. The discrepancy suggested China was buying far more than it publicly disclosed, a pattern analysts had suspected for years. Russia had dramatically boosted its holdings to 2,329 tons by May 2025, positioning it fifth globally. This was part of Russia's aggressive de-dollarization strategy following Western sanctions. Turkey expanded to 624 tons by March 2025, mandating that commercial banks hold 20% of their reserves in gold. India added 73 tons in 2024, reaching 880 tons by March 2025. Poland, Hungary, Singapore, all accumulating. The pattern was unmistakable. These weren't purchases made in response to short-term price movements or tactical positioning. These were strategic balance sheet decisions. Central banks were treating gold as what it had always been before the modern dollar era, the ultimate reserve asset, the asset that no government controls. That can't be printed, that can't be frozen or seized or devalued by political decree. Importantly, this buying was largely price insensitive. When private investors buy gold, they tend to chase momentum and flee corrections. When gold hits new highs, retail buying surges. When prices pull back, selling intensifies. But central banks don't operate that way. They're not trying to time the market or generate trading profits. They're building reserves for the long term, for generational stability, for protection against systemic shocks that may occur decades from now. This means central bank buying creates a price floor, a structural bid that supports gold prices during corrections and prevents the kind of crashes that purely speculative markets experience. By 2024, adjusted for inflation, real gold prices had surpassed their previous peak from the 1979 oil crisis. Gold reserves held by central banks stood at levels close to those last seen in the Bretton Woods era, though they now accounted for a far smaller share of total gold supply because so much more gold had been mined since then. But here's the truly historic development. For the first time in decades, the market value of gold held by foreign central banks approached and potentially exceeded their holdings of U.S. Treasury securities. Central bank gold reserves were valued at close to $4 trillion by late 2024. That's roughly equal to, and in some estimates surpassing, foreign-held U.S. government debt. Gold had become the second largest global reserve asset after the dollar itself. This wasn't supposed to happen. In the modern financial system, gold was supposed to be a relic, a barbarous remnant of pre-fiat currency days. Central banks were supposed to hold dollars and treasury securities because those assets earned yield, were highly liquid, and were backed by the full faith and credit of the United States, the world's largest economy and most powerful military. But that logic depended on trust, and trust was eroding. The freezing of Russian reserves demonstrated that dollar assets weren't truly neutral. They came with political strings attached. The surging U.S. national debt, described by investor Ray Dalio as a potential heart attack threatening the economy, raised questions about long-term fiscal sustainability. The increasingly weaponized use of financial sanctions made countries question whether dollar dependence was a vulnerability rather than a strength. And so slowly at first, then rapidly, central banks began treating gold differently, not as a legacy holding to be gradually reduced, but as a core strategic asset to be actively accumulated. Throughout 2025, gold's price trajectory reflected this new reality. The year started around $2,640 per ounce. By April, it had reached $3,200. By October, it broke $4,300. Each new high was accompanied by predictions that prices had moved too far too fast, that a major correction was imminent, that buyers were exhausted. But the corrections never came, or rather they came and were immediately bought. Gold would pull back briefly, then resume its ascent. The pattern repeated throughout the year. Why? because every time prices dipped, central banks were there buying, because geopolitical tensions kept escalating, because inflation remained sticky despite central bank efforts, because the dollar kept weakening, because real interest rates stayed low or negative, because institutional investors who had been underweight gold began rotating into the metal. By the time gold hit $4,000 in October 2025, it had gained 67% for the year, the largest annual gain in decades. Analysts scrambled to revise their forecasts. Targets that had seemed aggressive at the start of the year were being hit with months to spare. But few predicted what would happen in January 2026, because January 2026 wasn't just about fundamental supply and demand or central bank buying patterns. January 2026 was about fear, about the breakdown of institutional norms, about political chaos in the world's largest economy, creating an existential crisis of confidence in dollar-based assets. It started on January 3rd when the United States launched a strike on Venezuela, capturing the country's leader, Nicolas Maduro. Then on January 9th, the U.S. Department of Justice opened a criminal investigation into Jerome Powell, the chairman of the Federal Reserve. The official reason given was related to the cost of a renovation project for Federal Reserve buildings, but Powell knew better. In a video response on January 11th, Powell stated bluntly, "The threat of criminal charges is a consequence of the Federal Reserve setting interest rates based on our best assessment of what will serve the public rather than following the preferences of the president." Translation: the president wanted lower interest rates. The Fed maintained independence. And now the president was using criminal prosecution as a tool to pressure the Fed chairman. This wasn't normal political disagreement. This was an attack on the independence of the Federal Reserve, one of the foundational institutions of the modern global financial system. If the Fed couldn't set interest rates based on economic data without fear of criminal prosecution, what did that say about the rule of law in America? What did it say about the stability of dollar-based assets? What did it say about the credibility of U.S. Treasury securities, whose value depended on the Fed's perceived independence and competence? Markets reacted with shock, not by selling dollars initially because there was confusion about what this meant, but by buying gold, lots of gold. Spot prices began climbing. 4,200, 4,400, 4,600. On January 12th, gold smashed through $4,600 per ounce for the first time, extending its record-breaking run. Then came January 27th and 28th, when everything accelerated beyond control. President Trump threatened a 100% tariff on Canada if it proceeded with a trade deal with China. Tensions with Iran escalated dramatically as Trump threatened major military strikes after Iran refused conditions for discussions. On January 27th, the Federal Reserve held interest rates steady at 3.5 to 3.75%. The decision itself wasn't surprising. What was surprising was the context. A Fed chairman under criminal investigation, a president openly hostile to Fed independence, and mounting questions about whether the Fed could function effectively under political duress. On January 28th, gold exploded. It rose more than $300 during the course of a single day. $300 in one day. By the time Asian and European markets closed, spot gold had reached $5,589 per ounce, the highest price ever recorded in the history of gold trading, not just in nominal terms. When adjusted for inflation, this price eclipsed the 1980 peak that had stood as the inflation-adjusted high for over 4 decades. Silver, which tends to amplify gold's moves, surged past $110 per ounce, also hitting all-time highs. The velocity was stunning. Gold hadn't just broken $5,000. It had smashed through it with such momentum that some trading desks couldn't keep up with the pricing. The iShares Gold Trust, one of the largest gold ETFs, saw record trading volumes. Individual investors, institutional funds, sovereign wealth funds, everyone was buying at once. The rush into safe haven assets over that weekend and into Monday's trading reflected a flight to safety unprecedented in modern markets. Investors weren't just worried about missing out on gains, they were genuinely frightened about what was happening to the global financial system. Adrian Ash, head of research at Bullion Vault, captured the sentiment perfectly. For precious metals this year, the major drivers are going to be Trump and Trump, meaning Trump's unpredictable tariff policies and Trump's attacks on Federal Reserve independence. The combination created an environment where traditional risk assets felt increasingly dangerous and dollar-based reserves felt increasingly vulnerable. And so capital flooded into the one asset that wasn't anyone's liability, that couldn't be printed or frozen or manipulated by any single government: gold. But here's what the January spike obscured. The structural drivers that had been building for years were still in place. China's September initiative to court foreign central bank gold wasn't a one-time event. It was an ongoing campaign. The Shanghai Gold Exchange continued pitching custody services. More nations were reportedly expressing interest. The feasibility of storing reserves outside Western financial centers was being actively explored by finance ministries around the world. Central bank buying, while it might slow slightly from the peak pace of 2022 through 2024, was expected to remain well above historical averages. Goldman Sachs estimated central banks were now averaging around 60 tons of purchases per month. That's roughly 720 tons annually, far above the pre-2022 average of around 200 tons per year. The de-dollarization trend was accelerating, not reversing. Russia and China were conducting over 90% of their bilateral trade in rubles and yuan rather than dollars. Other nations, including Argentina and India, were pursuing local currency settlement arrangements. The dollar's share of global foreign exchange reserves had fallen from over 70% in 2000 to around 58 to 59% by 2024. That's still dominant, but the trajectory was clear, and each percentage point lost represented tens of billions of dollars shifting into alternative assets, with gold being the primary beneficiary. Major financial institutions recognized the paradigm shift and updated their forecasts accordingly. Goldman Sachs, which had started 2025 projecting gold might reach $3,700 to $4,000 by year-end, revised upward repeatedly. By January 2026, Goldman was forecasting $5,400 per ounce by the end of the year, up from $4,900 previously. The bank's logic: hedges against global macro and policy risks had become sticky, meaning they weren't temporary election-related trades that would unwind quickly. Concerns about fiscal sustainability, Fed independence, and geopolitical tensions were likely to persist throughout 2026 and beyond. JP Morgan projected $6,300 per ounce by end of 2026, citing continued central bank demand and what the bank called real asset outperformance versus paper assets. UBS suggested gold could reach $5,000 in the first half of 2026 alone. Bank of America raised its target to $5,000. RBC Capital Markets forecast $4,600 average for the year, rising to $5,100 in 2027. Citi, Deutsche Bank, Morgan Stanley, Wells Fargo, all publishing forecasts in the $4,000 to $5,000 range or higher. This wasn't a few outlier analysts making aggressive calls. This was Wall Street consensus shifting to accommodate a new reality. Gold was repricing higher, and that repricing was based on structural changes to the global monetary system, not temporary factors. The narrative had changed. In previous gold bull markets, the metal's rise was typically attributed to specific catalysts: inflation spikes, currency crises, war premiums. When those catalysts faded, gold would retreat. But this time, multiple structural drivers were reinforcing each other. Inflation remained above central bank targets in most major economies, despite years of tightening. Real interest rates, after accounting for inflation, remained low or negative in many jurisdictions. The dollar was weakening as the Fed signaled potential rate cuts and as global trade patterns shifted away from dollar dominance. Geopolitical tensions were intensifying rather than resolving, with conflicts in multiple regions and great power competition between the U.S. and China escalating. And most importantly, trust in Western financial institutions was declining, not catastrophically, not to the point of immediate crisis, but steadily, persistently, enough to change behavior at the margin. Central banks that might have been satisfied holding 70 or 80% of reserves in dollars were now targeting 60 or 50%. Nations that had never seriously considered gold as a major reserve asset were now accumulating. The shift was gradual in any single year, but dramatic when viewed over decades, and it appeared irreversible short of a major change in U.S. fiscal policy, geopolitical strategy, or institutional credibility. China understood this better than anyone. The September meetings at the Shanghai Gold Exchange weren't desperate attempts to attract business. They were strategic positioning for a world where London's dominance was no longer guaranteed. China didn't need to become the world's largest gold market immediately. It just needed to become a viable alternative, a second hub that reduced systemic dependence on any single center. Once that credibility was established, network effects would work in Shanghai's favor, just as they had worked in London's favor for a century. The infrastructure was being built deliberately. In 2025, the Shanghai Gold Exchange launched its first offshore vault and contracts in Hong Kong designed to increase yuan-denominated gold trading volumes. The People's Bank of China eased restrictions on gold imports to support market development. China operates over 20 major refineries with combined capacity above 2,000 tons annually. The domestic market for gold jewelry, bars, and coins was already the world's largest. What China lacked was the international trust and institutional depth that London possessed. But trust can be earned. And in a world where Western institutions are increasingly viewed with suspicion by emerging markets, China had an opening. Some analysts questioned whether gold's January 2026 spike was sustainable. They pointed to the extreme volatility, noting that silver in particular had exhibited moves reminiscent of a speculative mania. They warned that if Trump's policies succeeded in accelerating economic growth and reducing geopolitical tensions, gold could give back significant gains. They noted that gold pays no yield, meaning opportunity costs rise if real interest rates increase. They cautioned that the technical indicators showed extreme overbought conditions, all valid points. And indeed, following the January peak, both gold and silver experienced sharp corrections. In early February, gold dropped over 20% from its highs, falling back toward $4,200 before stabilizing. Silver crashed even harder, losing 40% at one point. But here's what the corrections didn't change: the structural drivers. Central banks didn't stop buying. China didn't abandon its custody initiative. The U.S. fiscal deficit didn't shrink. Geopolitical tensions didn't resolve. The Fed remained under political pressure. De-dollarization continued. Every correction was met with buyers who understood that gold's role in the global monetary system was being fundamentally repriced. This wasn't like 1980, when gold spiked to $850 on inflation fears and then collapsed for 2 decades as inflation was conquered and the dollar strengthened. The current environment was different. The challenges were structural, not cyclical. Fiscal trajectories were unsustainable. Political systems were polarized. Geopolitical order was fragmenting. And the dollar, while still dominant, was facing the first serious challenges to its hegemony since the Bretton Woods system collapsed in 1971. Moreover, gold's behavior in 2025 and early 2026 defied traditional models. Historically, gold and real interest rates showed a strong inverse correlation. When real yields rose, gold fell because the opportunity cost of holding non-yielding gold increased. When real yields fell, gold rallied. But in 2025, gold surged even during periods when real yields were elevated or rising. This suggested that something beyond traditional interest rate dynamics was driving demand. That something was fear. Fear of sanctions, fear of currency debasement, fear of political instability in reserve currency countries, fear of losing sovereignty over one's own reserves. Fear was harder to model than interest rates, but it was proving to be a more powerful driver. The World Gold Council noted that gold's 2025 performance provided significant portfolio diversification benefits, with relatively low correlations to other major asset classes. This was particularly evident during the April 2025 market decline following Trump's tariff announcements, when gold held strong while equities fell. Gold was functioning as it was supposed to, as a hedge against systemic risk, as an insurance policy against institutional failure. And as long as those risks remained elevated, demand would remain strong. Financial advisors began recommending 10 to 15% portfolio allocations to precious metals, up from traditional guidance of 5 to 10%. This higher allocation reflected both increased systemic risks and gold's enhanced role as a portfolio stabilizer. If even a fraction of global institutional portfolios shifted toward these higher allocation percentages, that would represent hundreds of billions of dollars of incremental demand for a market with annual mine production worth only around $170 billion. The supply side offered little relief. Mine production had been essentially flat for years. New discoveries were rare. Lead times for developing new mines were 7 to 10 years minimum. Recycling provided some supply, but was limited by the fact that gold, once fabricated into jewelry or held as investment, tended to stay off the market unless prices reached truly extreme levels. The gold market was structurally tight, with demand from central banks, investors, and traditional sources like jewelry and technology all competing for limited supply. Every additional source of demand put upward pressure on prices that supply couldn't relieve quickly. Looking forward, multiple scenarios were possible. In the bearish case, Trump's policies might succeed beyond expectations. Economic growth could accelerate, inflation could fall. The Fed could regain full credibility and independence. Geopolitical tensions could ease. The dollar could strengthen dramatically. Under these conditions, gold might retreat significantly, perhaps back to the $3,000 range or even lower. Some of the speculative premium would evaporate. Safe haven demand would decline. Central banks might slow their accumulation. This scenario was possible, but required many things to go right simultaneously. In the base case, gold would consolidate in the $4,000 to $5,000 range throughout 2026. Central banks would continue buying, but at a moderated pace. Geopolitical risks would remain elevated, but not spiral out of control. U.S. fiscal concerns would persist, but not trigger crisis. Institutional allocations to gold would gradually increase. This scenario seemed most probable given the structural drivers in place. In the bullish case, one or more of several catalysts could push gold well beyond $5,000, potentially toward the $6,000 to $8,000 range that some analysts mentioned as possible. These catalysts might include a major escalation of geopolitical conflict, a loss of Fed independence triggering a dollar crisis, a sovereign debt crisis in a major economy, a successful launch of BRICS alternatives to dollar-based payment systems, a dramatic acceleration of de-dollarization by multiple large economies simultaneously, or a financial market crisis that revealed hidden vulnerabilities in the banking system. None of these scenarios were inevitable, but none were implausible either. And in any of these scenarios, gold would be the primary beneficiary as capital fled toward the hardest, most neutral, most trusted asset available. What made January 2026 potentially historic wasn't just the record price, it was what the price represented. For the first time in generations, gold was seriously challenging the dollar's dominance as the world's preferred reserve asset, not in terms of current holdings yet, but in terms of trajectory, momentum, and institutional intent. Central banks were voting with their purchases. They were saying explicitly through their actions that gold's share of global reserves needed to be higher. That dollar dependence was too concentrated, too risky. That diversification was prudent, necessary, urgent. The meetings in September 2025 at the Shanghai Gold Exchange crystallized this shift. They weren't the cause of gold's rise. They were a symptom, a manifestation, evidence that the tectonic plates of global finance were moving in ways that would reshape the landscape for decades. London would remain the largest gold market for the foreseeable future. Western financial institutions would continue to be central to global commerce. The dollar would retain its reserve currency status for years, perhaps decades. But the monopoly was breaking, the unquestioned dominance was ending, and in its place, a multipolar system was emerging, a system where gold played a larger role, where Shanghai competed with London, where yuan-denominated gold contracts grew alongside dollar-denominated ones, where central banks in Africa, Asia, and Latin America no longer automatically stored their reserves in New York or London, but had genuine choices. The secret meetings of September 2025 may have been conducted in confidence, away from public scrutiny, without fanfare or formal announcements, but their impact will echo through financial history. They mark the moment when the old order began its slow, inevitable transition to something new. When gold, the oldest form of money, proved once again that it was also the most durable, the most trusted, the ultimate reserve asset in a world where trust in institutions was the scarcest commodity of all. Gold's breakout to $5,589 on January 28, 2026 wasn't the end of this story. It was the beginning of a rebalancing, a repricing, a recognition that the post-World War II monetary system built around dollar dominance was giving way to something more distributed, more contested, more complex. How far this transition would go, how quickly it would unfold, how the West would respond, all remained to be seen. But one thing was certain: the meetings in September changed everything, and the gold market was telling us exactly that, in the only language it knows how to speak, the language of price, the ultimate truth teller in a world of unreliable narratives. $5,589 per ounce. That's what sovereignty costs now. That's what independence looks like. That's the price of freedom from a system where your reserves can be frozen on political grounds. And central banks around the world are saying loudly and clearly through their purchasing patterns that the price is worth paying.